Hello, everyone. I hope you're doing well. Thursday. Uh, we don't usually have our live sessions on Thursday because I usually want to wrap up the week on Friday. But the reason that I've decided to uh, hold the live session today is tomorrow will be a very important day in terms of news and the uh, things that are happening in the Middle East. Tomorrow, uh, the Islamic Republic uh, ambassadors and officials are going to have a meeting with the American officials regarding the situations and the chaotic atmosphere uh, of Iran and the things about Iran. Uh, so the market is going to be so uh, fluctuative tomorrow, I believe. And today we are going to talk about the scenarios. If things go well, what's going to happen to the market, and vice versa, and the next movements that we can expect from USD, gold, oil, especially oil, and um, indices, majorly the Dow Jones. Uh, Last week, I was a little bit biased about the market and about the movements of the prices in different markets. Today, we're going to talk about them as well. And then we will consider the different scenarios and possibilities uh, about each asset and the fundamentals of the market as well. So let's start with EURUSD. Now I have the daily chart of EURUSD in front of me, and let me zoom out so you can see the chart better. Uh, Last week we talked about the probabilities of the price movement for EURUSD. If you remember, I told you that the price is in a trading range at the moment, and the sellers will do their best in order to take the price lower, and the buyers will buy at the 50% pullback uh, of the previous move. I'm talking about this move, a very strong move that we witnessed last week. And as you see, that happened. Uh, if you consider this as the trading range, you can see the sharp breakout from the trading range, and now you can see the rejection and bad follow through for the bulls. Although the final bar, the the trend bar is so big, uh, the bears sold it uh, for the pullback to the top of the trading range, and uh, thus the bull bar was weak the bulls were not interested to try to take the price higher to the highest close of the bull trend bar, which is this area, and prices started to fall. And actually, it dropped to the 50% of the bullish move. So here's the 50% of the bullish move. If you consider this move as the first leg and this move as the correction, you can consider this correction as a two-legged correction. For example, you can look at it as the first drop and then pull back, and the second drop, first leg, pull back, second leg, or you can wait for another leg down. So it would be the first leg down and then pull back. It can be a small pullback or a big pullback, and then the second move would be lower than this low. So bears expect lower highs and lower lows in this area. Oppositely, the bulls are saying uh, an opportunity to buy at the 50% pullback of the whole bullish move, and they've been so strong. You can see 6 bull bars in this move, 1 week bear bar, and out of these 6 bull bars, 5 of them have been so strong and closed at high or above the midpoints, and shows the strength of the bulls. And due to that, the bulls expect the price to go higher to make another higher high, or to the highest close of the bulls. Say there were traders, they were institutions who bought at this level, and they're buying lower to take the price to this level again, so that they would have the chance to exit their original entries, and with no profit. They're gonna exit their positions break even, and they're gonna make money, make profits from their second entries. So it can be a scenario for the bulls that make them interested to buy. Some of them are buying right now. Some of them are waiting. They're giving the price some time to show some strength, uh, bullish strength, to make them confident to buy again. And for the bears, I do not expect them to change the move of the whole bullish wave. I do not expect them to create a bearish trend, but you should consider the fact that, as I told you, we are in a very big trading range, and they sold the top of the trading range after the bullish breakout. And it is possible for the bears to expect the price to go lower to the bottom of the trading range, or the to the area that the bears believe that it's a fair price area. So they're gonna exit their positions, and the bulls are gonna buy again. Uh, to me, since this leg is so strong, I expect another leg up before a leg down. But who knows? Maybe the bears get stronger and take the price lower to the bottom of the trading range channel. That is possible as well. And for the people who trade on lower time frames, for example, the hourly time frames, here's the 1 hour time frame of EURUSD, and you can see the strong bullish wave. Let me zoom out so you can see. You can see the breakout and then follow through, flag, another breakout, flag, another breakout. And here you can see lower lows and lower highs. Lower highs here, a series of lower highs, but not lower lows, and then a strong drop from this area. So we could expect the price to fall as big as the first leg. It didn't happen. The price did try to reach this place, this area, which is the bottom of the bull channel. Here is the bottom of the bull channel. Okay, so the bears tried to take the price to this area, but they couldn't. Now the price is in a trading range, a tight trading range in comparison to the whole move. Look at the whole move, the move up, and then the move down, and now the price is in a trading range. And look at the trading range. It's a tight trading range. Most of the people who are trading on hourly time frames, for example, the 1 hour time frame, let the price make a breakout to find out where the price is going. They will wait for a breakout and a follow through bar to establish the breakout, to confirm the breakout, and then they trade with the trend, with the breakout direction. And there are some other types of traders who trade within the trading ranges or even tight trading ranges. They try to trade a small scalp. They try to go for small profits, and they're more comfortable in this type of trading. And for these people, they can buy low, sell high. They can use limit orders for their trades. For this case, they can use stop orders as well. So bulls could buy here, the stop down here in scalp. The bears could sell here and then scalp out their positions. They cannot expect a sharp move for 80% of the time, meaning for 80% of the time, all the breakouts will fail and the price will get back to the trading range again. That's why both bears and bulls are scalping. They're not swing trading. But for the swing traders, they can wait for the price to make a breakout, and then they can trade with the trend. In that case, since the price has been in a trading range for more than 20 bars, it is considered a long trading range, meaning the price has been in the trading range in a for a long time. So the influence of the previous move is not as strong as it used to be when the price was in this phase or in this phase. Uh, right now, the chance of breakout for bulls and for the bears are 50%. So 50% chance of the bullish breakout and 50% chance of the bearish breakout. So traders should consider this fact. And for higher probabilities, for a more confident position, both bears and bulls should wait for the trading range to break, and then if they see uh, a good confirmation from the breakout, they can trade with the trend. Or if they believe that the the breakout is not gonna succeed, they can take a reverse position, but they have to realize it early. So it mustn't be a late entry because the price is in a tight trading range, and the place you take the trade might be the place that you should have exited the position. Okay, do you understand? So you have to consider that very much. That's why I'm recommending you to wait for the breakout. Oil. Uh, Oil experienced 66, if I'm not mistaken. Let me just tell you the exact number. Yeah, $66.53. It is West Texas oil, and it's been a record. Um, and right now, uh, the bulls are more confident to buy any pullback, and you can see the price action of oil, and that is directly connected to the chaotic situation happening in the Middle East. You can see the price behavior changes since the middle of December, and from uh, the 8th of January, the price has had a different behavior. You can see very sharp bullish moves, very strong candles, and very mere pullbacks. After four strong bull candles, two of them are very strong. Uh, the other two closed above their midpoints. So it shows that the bulls are strong. And after that, you can see the bear's reaction here. Um, Although a trend bar, a bearish trend bar, but a turbo follow through, and then bulls got confident, and you can see the strong bull bars closing at their highs, especially this one, and this one. And then you can see the breakout from this high. So it shows the strength of the bulls, and you can see a very good follow through after the breakout and another big bull bar. And now again, although the price opened with a gap, uh, And although it closed below the midpoint, I mean the bearish bar, it was bought, and there were bulls below the bar, below the bear bar, uh, to buy, to take the price higher. And after that, you can see a bull bar, which is good news for the bulls. They can consider it a good follow through bar. And today, at this moment, oil is $63.81, 80 cents. And I believe that the if the situation uh, gets worsened than it is, uh, the price will go higher. Oil will go higher, because oil goes higher whenever it is in a chaotic situation, in a chaotic atmosphere. But if we hear good news, the market starts uh, correcting itself. There are sellers, they sell because they believe the price is too high, and uh, in a technical perspective, uh, bull the bulls could not go higher than the major high that I talked about in the last week. If you remember, I told you that this high is a very, very important high for the bears and bulls. And bulls could uh, reach this area, but they couldn't make a breakout, and they couldn't establish themselves above this high. But they're trying to do so. So another leg up is so probable. And if the situation continues like this, we can expect a very bullish wave above this high, and maybe the price goes higher even without a pullback, or a pullback to this high again, and then uh, another leg up for this high. If you see, so another leg up, uh, another destination for the bullish move is the top of uh, this area, which is at $70. So, which is a round number. Uh, It is expected for the bulls to reach this area if the situation continues like this, if we keep hearing bad news for the market. And vice versa, uh, the odds are different for the price to experience lower levels, lower support areas, if we if the market uh, understands that this price is too high. So we might witness a correction in this scenario, and the correction might be somewhere between the 50% pullback of this whole move. It'll be something around this area, and lower to this area. But I think it takes some time for the price to reach this area. It's not gonna be a short move, uh, because in politics everything is slow most of the time. And to me, we should wait to see if we're gonna see any improvements in the situation of the Middle East, or the situation is gonna be more dramatic and chaotic in the near future. So for the uh, next day, which is Friday, and the next week, the oil market will be so fluctuative. So you have to consider your risk management strategies, your money management strategies. You have to stick to your plans, and you have to wait for stronger confirmations if you want to trade oil. And for the people who trade oil on lower time frames, you already see the fluctuations in the 1 hour chart. The price is in a trading range right now. You can see the trading range here. It is the area where the bulls and the bears are trading. You can see the rejection from this area, and then one pullback, uh, the first leg down, which is so strong. You can consider this one the first leg of the pullback, or this whole move the first pullback, and the first leg of the pullback, and a correction within the pullback, and another leg down. So it is a two-legged move. Uh, Leg one, pullback, leg two, and you can consider this area to be a good area as a support. So bulls will be here to buy if they see some strength, um, some bullish strength at this level, for another leg up. So to me, if you want to trade oil on the hourly time frame, it's better to buy low and sell high, and mostly scalp. Meaning you must not consider the price to go very far away. Uh, Remember that you can always re-enter your positions. It's better to gain some profit from your trades rather than just losing them because you believe that there's gonna be a breakout. For most of the time, the breakouts are not gonna succeed, and you can risk free your positions when the price reaches the other side. For example, it can be a useful piece of advice. For example, you buy here at this level, which is $62.63. Okay, let's say you buy here, and you can risk free your position when you see um, a correction is happening from the first move up. So you can consider this a double top, and it is going lower and lower. First leg pullback, second leg. If you bought here, your stop is down here, and you can risk free your position. I'm not saying that it is a strategy that works for 100% of the time. No, it is not like that. My point is, it's better to exit the position when it is against you and you are in a trading range. Okay, because levels are broken much easier in a trading range than a trend. Okay, in a trend, the a stronger side um, protects the lows and the highs of the trend. But in the trading range, traders are not confident. The institutions are not confident, and they wait for the breakout to hold on their positions. So in a trading range, they do not hold on their positions. So there'll be aggressive sellers above, like here you can see after a very strong bull bar, you can see a doji and then aggressive sellers. So the people who didn't sell out their longs here have lost about like $15, uh, sorry, uh, like 17 pips, which is around $2. Yeah, so which is a huge amount of money if the position is strong and heavy. So it's better to consider exiting your longs when the price is near the top of the trading range, and vice versa, consider exiting your shorts when the price is near the bottom of the trading range. Like here, you can see a very strong drop and tight trading range, pullback, and then another attempt to this area. And once the price was getting closer to this area, the bulls started to buy, and that's why you can see a strong move up. And the people who sold here were in a losing position when the price was here. So you should not stick to your position when you are in a trade range. You try to exit your positions for most of the cases. And for now, the price is trying to go lower to the top of the support area, and we will get back to oil in 10 minutes, 20 minutes later to see what has happened. For Dow Jones, it is still in a very strong bullish wave, as I told you, and it went up actually. Yeah, today is Thursday, and this bar is Monday. So a very strong move up on Monday, and it was expected since the price is in a very strong bullish wave, a very tight bullish channel. And you can consider the channel like this, and you can clone the line and put it at the top of the bell leg. And now you can consider the price to be in a tight trading range for 50% or more. The breakout will be from the top side because we are in a very strong and tight both channel. This channel is like a breakout on higher time frames. See, if you look at the price on the monthly chart, you can see the breakout here, like 9 bull bars and no bear bars. So it shows that the bulls are so strong. They're buying. They've been buying for about a year. Yeah, 9 months. So the odds are in favor of the bulls, and here on the daily chart the price is in a tight trading range. So to me, uh, the odds are in favor of the bulls, as I told you, but it is possible for the birds to take the price lower to the bottom of the uh, bull channel, and there'll be buyers below, so it'll be bought again. But it's a less probable scenario for the price action of Dow Jones on the daily chart. Uh, the odds say that we will have another leg up to the top of the bull channel, the bull tight channel. And for the people who trade on lower time frames, for example, the hourly chart, it is the box that I drew on the daily chart. It was a very tight trading range on the daily chart, but here on the hourly chart, it is a wide trading range. So traders consider buying low and selling high. See, when the price is in a trading range, they do not hold on their positions. I mean, the institutions, because they're not confident and they know that for 80% of the time, the breakouts will not succeed. So they're exiting their positions when they're close to the top of the trading range, or when they're close to the bottom of the trading range. And let me have a closer look. It is the trading range on the 1 hour chart. And look at the price action. If you consider this high as the first high in a trading range, in the trading range that the price is in currently, and this low as the strongest low of the trading range, you can see that the bulls didn't have much difficulty to take the price to the top of the trading range. They bought aggressively, and the price went up sharply. But what about the bears? The bears, yeah, the bears couldn't take the price lower in ease. Yeah, they had difficulties to lower the price. See, the first leg down and a very sharp leg up, and then a sharp leg down, and then trading range, tight trading range for many bars, and then another sharp leg down, but bulls butted, a bad follow through, the same scenario, and finally they gave up when they were close to this low. Uh, these attempts are the attempts to take the price to this low. They wanted, and they knew that there are a lot of bulls that are ready to sell their long positions. They were ready to exit their positions. So they wanted to collect the uh, volatility, the money, the stock money here. But the bulls protected their stop orders, and they kept buying at every low the bears created. Look at this low, look at this low, look at this low, and finally look at this low. Okay. Every time the bulls bought the low more strongly, more harshly. And finally, the bears gave up. They understood that they're not gonna make it to take the price to this level, to this low. But the bulls, they just took the price to the top of the trading range much easier. Look at the price action, much easier. And although uh, and although you can see the rejection from the top of the trading range, another leg up. So the people who bought here and scaled in to their position lower could exit here, uh, break even from their original position, and with some profit from their second position. So it shows the strength of the bulls. So you can look at the price action and understand. Uh, with this logic, we can understand that the bears have difficulties to take the price lower. They have had difficulties to take the price lower so far. Maybe something happens and they could take the price lower much easier. But so far, they haven't been successful to do so. But oppositely, the bulls have been so strong. That's why, based on this scenario, I believe that the breakout will be from the top of the trading range. But as I told you before, when the price is in a trading range for a long time, the influence of the previous move decreases, and the odds for the bears and bulls will be the same 50-50. 50% the chance from a, for a breakout from the top side, and 50% chance for a breakout from the bottom side. Okay, so for now, bears are selling. You can see a very strong bear bar, and the follow through hasn't been so promising for the bears. And 60 46 minutes left. uh Sorry, it is 46, yeah, 46 minutes left to close this bar. So bears have like 46 minutes, 45 minutes to show their strengths, to show the bulls that they're strong. So the bulls will not buy till the price goes lower, uh, till they understand that the bears are not as strong as they used to be. But for now, you cannot see that pressure, and maybe the bulls are gonna buy. Since after each big bar, you can see a bad follow through and a bull bar. You can see it here, you can see it here, you can see it here. After three bars, you can see it here also, here also. So let's see what they're gonna do. Okay, and finally, my favorite asset, gold. Gold has been so frustrating for many people. I can understand them. I can understand them because they didn't expect the price to fall like that. It's been the biggest bar in the history of gold. I mean, this bar uh, that occurred on the 30th of January. Yeah, and you can see a gap the price opened with a gap, and then the gap filled. So it shows the strength of the bulls, and you can see that it is the EMA 20 on the daily chart, uh, and there is a mere gap between uh, the EMA and the open of the bar, the bear bar. You can, if you can see it here, here's the open of the bar, and here is the EMA. So it shows that bears uh, were kind of strong to hold the price below the EMA for a short time, although bulls bought it and the gap closed, both the EMA gap and the actual gap that you can see here, the window that you can see here. And some traders consider this move as the first leg of the whole correction of the bullish move. First leg pullback, second leg. Some other people see this move as the beginning of another leg up. I don't know, because at this point the price is kind of in the middle of a trading range. I consider this a trading range right now, although it is not like a trading range, but it is forming a big trading range. Big leg down, big leg up, uh, big frustration, big confusion. And now we should sit down and see if the bulls are gonna succeed to take the price higher for another leg up. That could be to this high, which is the highest close of the bulls, or maybe uh, to create another higher high, or the birds are going to create a two-legged correction. First leg pullback, second leg, and then there'd be bulls to buy below this low. At this point, we don't know. Uh, let's draw a channel. You can consider this channel like this. I do not, because there is a huge gap and a huge timeline from this gap and the price action, so it is not a valid trend line for me for this one. Maybe if the price goes lower, uh, this trend line will be more valid, but at this point it is not um, my favorite trend line to consider. I prefer this one because it is more updated, and you can see the price reacted to it. So it is a more valid trend line, and if you just clone the line and put it at the top of the previous bear leg, you can see a breakout from the top of the bull channel, but the breakout didn't make it. After two big bull bars, the price started to fall, and it fell to the bottom of the bull channel. So this line is valid, and I don't know, maybe they're gonna take it to the bottom of the channel again, and maybe they're gonna take it to the bottom of the white channel trend line. I don't know. It is completely related to the news and to the upcoming events. To me, right now, mm, trading has become much more difficult than before. Uh, the setups are not working properly, and the traders keep trading their previous setups, but the setups are not working. And it shows that something happening on the higher time frames. When you're trading, for example, you're trading on a 5 minute chart and your setup, you understand the cycle of the market, you understand the setup, you stick to your rules, and you take a perfect position. By perfect, I mean you execute, sorry, you execute the position perfectly, but the market goes against you. That shows something is happening on the higher time frames. So the higher time frame is not supporting the lower time frame. That's one of the reasons. So it's better to consider the higher time frames nowadays to see what they're gonna do and what they're doing. For example, on the 4 hour chart, see, do you see a harsh move up, a drastic move down, and then another leg up, pull back? Is it gonna be like this, or is it gonna be like this? You tell me. What is your opinion? Who knows? Uh, at this point, it is 50-50 because both bulls and bears have been strong. I can understand that since it's been trending for a long time, the odds are in favor of bulls. Uh, and the bear scenario says it's been the strongest bear leg after a long time. And many uh, sellers expect the price to give them another leg down. So for this move, for this big move, uh, they expect a two-legged correction. I can understand both parties, the both scenarios, uh, but I'm saying it is in the middle of a trading range. Yeah, if you want to trade, your stop orders are too far. Yeah, the stop loss order for the bulls is here, and for the bears is here. The bears have the probability, and the bulls have the risk reward. Meaning, if you buy here, you make more than your risk, and if you sell here, you make less than your risk, but it's a higher probability trade. For bulls, like 40%, like 45% chance to have another leg up. For bears, something around 60%. So it's up to you to go for the risk reward, to go for a better risk reward position, or to go for probability. and it is completely related to your trading style, to your trading strategy, money management, and risk management strategies. So you have to consider all these things. Uh, Most of the people consider risk and reward in their positions, which is good. But you have to consider the probability as well. So, for how much percent you think that it's going to be a successful trade or not. So, that is very important. And it is not quite obvious for most of the time. Yeah, sometimes it is 40 to 50%, sometimes something around 60%. Uh, but whenever you have a better risk reward ratio in your trade, you are taking a less probable position, a position with less probability of success. And whenever it is vice versa, it means that you're taking a higher uh, probable position that has a higher probability of success. And if you trade gold on lower time frames, for example, on the 1 hour time frame, the price action says a very sharp leg down. You can consider this the first leg pullback, the second leg. You can see many complex legs in this big leg, or you can just consider this move down the first leg and pull back the second leg. But the price action shows something else. See, you can see the gap between this close and the EMA. It shows that the the bulls have been strong enough to take the price higher, much higher than the moving average, and they have done it for several times here, and here, and finally here. Uh, I see a wedge here. So the first leg up, pull back, second leg up. I'm talking about the price action. So I can see something like this here. And the probability is to have another leg up from here or from here. I don't know. I really don't know. But the price action shows that. Why do I not know? Because the correction is at the 50% pullback of the whole move. So it is possible for the bulls to get trapped, and for like 40%, 30 to 40% of the time, we might have another a leg down, but it'll be so painful for the traders, because most of the traders expect a bear channel, which is a bull flag, to break from the top side. And if it breaks from the bottom side, many bulls will exit and the bears will sell more for another leg down, maybe lower than this low. But ultimately, it's gonna be a huge trading range. But for now, we cannot say. In terms of price action, the prices, I'm gonna go higher. But there are a lot of other things here. For example, see, the bear bars very strong, much stronger than the bull bars, and count them. They're more in terms of numbers. So from here to here, there are 27 bars and maybe around like 4 bars here, 4 bars, like 10 bars, 8, 9 bars, 9 bull bars in total. But the bears have more bars, more strength, so it is possible for the bears to succeed to uh, create a pain trade for the bulls. But we need to wait to see what they're gonna do. Mm, Tomorrow is a very important day for the market, and many things depend on it. So for tomorrow, be careful, trade small, use stop loss orders, and try to stick to your plan. After all, it is price action. You're correct for 40% of the time, 50% of the time, or sometimes 60% of the time. Sometimes you make mistakes, that's okay. Take your loss, and if your setup has been created, okay, take it. Use a stop loss for your orders, and uh, consider your money management, risk management, and take it. No worries. After all, uh, price is more important than any kind of news. The news is the fuel for the price to move faster. That's it. After all, it is based on price and price action. I mean, the market is based on price and price action. Okay, then. Thank you for your attention. Please tell me what you think about uh, gold and oil. And let's have another look. Yeah, see, it's trading range after a big bear bar, a terrible fall through for the bears because it's a trading range. In a trading range, this happens a lot. That's because bears and bulls take out their positions, exit their positions, take out their profits from their positions after bull, after trend bar, let's say. Yeah. And yes, please tell me what you think about oil and gold, or if you trade Dow Jones or EURUSD, tell me what you think about these two as well. And tell me what you think about the future of the financial markets in the following week. Do you think we're going to see more fluctuations in the next week, or the market will be in a trading range to find out the next direction? Okay, that's it for today. Hope you find it useful, and thank you for your attention. Goodbye.